So welcome back. So we'll now move to capital gains. Generally, the last few exams we have been always seeing around 8 to 10 marks of capital gains. So in order to convert to capital gains, you need to satisfy three conditions after section 45(1). There should be a profit or gain. The profit or gain should rise on account of transfer. The transfer must be in relation to a capital asset. So why profit or gain not defined and how to compute is given by section 48. So you can always proceed with the entire chapter with 48 as the basis. So then you can move from the profit or gain to transfer. Transfer is defined by section 247. So after section 247, sale, exchange, relinquishment, extinguishment, compulsory liquidation, conversion of capital asset, and so on and so forth are going to be regarded as transfer. Capital asset virtually includes everything. Two major exclusions from capital asset are rural agricultural land and stock in trade and personal effects. Stock in trade is because it's going to be taxed on the business income. The rural agricultural land for this purpose is one agricultural land situated in a place where the population is 10,000 or more, or even if the population is less than 10,000, if it falls within a distance of 8 kilometers and it's also notified by the government, then these land will become urban. All other lands is going to be considered as rural, and the sale of which will not result in any capital gains tax. Personal effects like your watch or your two-wheelers which are held for personal use are not going to be taken as capital assets. Except for this, everything else will be a capital asset. So if you take the case of a transfer, there are certain exception transfer provided by section 47, which we'll discuss later. So going on from this computation of capital gains, for this purpose you need to analyze the capital gains as short term or long term. If the capital gains is short term, then the computation of capital gains will be full value of consideration minus expenses minus cost of acquisition minus the cost of improvement less exemptions under 54B, 54D, 54G and 54GA. When you take the case of a long-term capital gains, three changes. The cost of acquisition will be replaced by index cost of acquisition. Cost of improvement will be replaced by index cost of improvement. And apart from the four exemptions of B, D, G and GA, you also get exemptions under three more sections, which is 54, 54EC and 54F. Now, the important question which arises now, how do you classify a capital gains as a short term or long term? For this purpose, you have to find out what is the assets. So in case if the capital asset transferred is shares or listed securities or units of UTI or a mutual funds or a zero coupon bond, you have to hold it for 12 months plus 1 day to become a long term. For any other capital asset, if you hold it for more than 36 months, it's going to become long term. What is most important to be noted here? In the case of the shares, equity, preference, listing, private, public, not relevant. But in the case of a debentures, you have to list it to come at a 12 months category. So that is one important key point which you note here. So once you identify the capital asset as short term or long term, any capital gains arising on short term is short term, any capital gains arising on long term is going to be taken as a long term capital gains. Now stay with the computation section. That's the easiest way to approach. Consideration normally will be given to you in the examination. Expenses in connection with the sale like brokerage etc. will be given in the question. So the difference is going to be called as net consideration. From there you subtract cost of acquisition. So the question which arises now is what is cost of acquisition? There is no need to define a cost of acquisition because cost of acquisition is nothing but the amount you pay for buying an asset. But then why the income tax act should define a cost? Because we have a very interesting concept of cut-off date in capital gains. Suppose if you have acquired the asset before 1/4/1981, then instead of choosing the actual cost, you are allowed to take the market value as on 1/4/1981. That is in 1978, you buy an asset for 5 lakhs. Its market value as on 1/4/81 is 10. So instead of choosing 5, you can take the cost as 10 lakhs. So that is one reason why this concept of meaning of cost of acquisition is known. Apart from this, in section 55(2), there are certain intangible assets, financial assets for which normally you may or may not have the cost, for which the law wants to specifically provide for the cost. For example, if you take the case of goodwill, there is no cost associated with goodwill, especially when it is self-generated. So what the law specifically provides for intangible assets, if it is purchased, purchase price will be taken as a cost. So if it is not purchased, then the cost of acquisition is going to be taken as 0. The one interesting point here is one, if it is a goodwill of a profession, it is not covered, therefore you don't have to pay tax on the thing. Now similarly, if these assets are purchased before 1/4/1981, you cannot substitute market value as on 1/4/1981. So as regards the financial assets, classify the financial assets like this. So if the financial asset is an original shares, then the amount paid for the original shares will be the cost. If the financial asset is a bonus shares, the cost is going to be taken as 0. If the financial asset is the right shares, the amount paid for the right shares will be your cost. Now, what will happen in the case of rights if you decide to renounce rather than subscribe? So, if you are a renouncer, your cost is going to be taken as 0. If you are renouncing, the cost of you will be the amount paid to the renouncer plus amount paid to the institution. So, that will be taken as your cost. Now, couple of interesting points, including bonus shares, that if you get the shares before 1481, you are allowed to take the market value as in 1499, which is not available for intangible asset. Another interesting point which you notice is how to calculate short term or long term. Original shares will be from date of allotment of original, bonus will be from the date of allotment of bonus, rights will be from the date of allotment of rights. That is how short term, long term is going to be decided. Now, apart from these sections, we have certain sections in 49.1, 49.2 and all provide for the cost of acquisition, certain special cases. So if you take the case of assets like if you get the asset say by way of a will or inheritance, you don't pay any amount for acquiring the asset. So therefore in those circumstances section 49.1 specifically provides you have to take the cost as cost of the previous owner. Now similarly if you get the assets say in an amalgamation or the merger, you are not going to pay any amount, but you become a shareholder because you have purchased shares in the selling company and there is a purchasing company is going to allot the shares. Therefore, what is the cost of the purchasing company shares in your hands because you have not paid anything? Take the cost of acquisition of shares in the previous company. Similarly, if you get the case of a demerger, so after demerger you will become a shareholder in both the demerged company and the resulting company. The cost of acquisition in the resulting company is going to be calculated on the basis of cost of acquisition of shares in the demerged company into the amount of value or book value of assets transferred to the resulting company on account of demerger divided by total net worth. Now this will give you the cost of acquisition as the resulting company under 49.2c. Obviously it goes without saying, you are paid for the shares of the demerged company. Now you are getting the cost of acquisition of the resulting company. Whatever cost you added here should be subtracted from the cost of acquisition of shares in the demerged company. Now demerger is a slightly challenging one because of the fact that so after the demerger you remain as a shareholder of the existing company plus you also become a shareholder in the resulting company. I'll give you a very simple example. You purchase shares in A Limited, which has got two divisions. It hives off one of the divisions into a new company B Limited. You have purchased the shares in A Limited say for 5 lakhs. The value of asset transferred to say the new company is 40 crores. The net worth of the new company, the existing company says 100 crores. The cost is going to be determined for the resulting company. The new company is 5 into 40 by 100, which is 2. Now the moment you arrive at 2 for the new company, the existing company cost will have to be reduced by this 2, which is going to be 5 minus 2, 3. But it goes without saying, for the purpose of calculating holding period of B, you can take from the holding period of A. Now same is the case in the case of inheritance and will, which talked about. You take the cost as cost of the previous owner, you can also take the holding period of the previous owner. Not only that, if any improvement incurred by the previous owner can also be claimed. The only challenge here then it comes to the question of indexation. So in the case of an indexation, you can either index based on the acquisition by the SSC or you can also index on the basis of acquisition of the previous owner. What you should do in the examination, clearly give a note as to which method you are following. You can either take the acquisition from the previous owner or from the SSC. That is one important area which you have to make it very clear in the examination before providing the answer for the same. So apart from this, cost of acquisition in the case of a depreciable assets is governed by section 50. Suppose you buy an asset for 10 lakhs and you already claim 6 lakhs of depreciation business income. You can't take the cost as 10 because already 6 lakhs has been allowed. Therefore section 50 says you have to take only the cost as 4 lakhs. So this you can link it with section 32 and read together. Now section 51 is another interesting section which provides for reduction of cost in certain cases. Now let's assume that you have received some advance money, but the buyer is not willing to pay the balance amount. So you put a small agreement whereby you say that if you don't pay the amount, I will forfeit the advance money. Now this forfeiture of advance money cannot be taxed because of the fact there is no transfer of asset here. So therefore what section 51 says, when you subsequently sell the asset to an outsider, then your cost of acquisition will be reduced by the advance amount. What is important to note, your cost could be in 81, your advance money forfeiture could happen in 2001. but still you have to adjust the cost of 81 with 2001 advance money. To that extent, the SSC is going to lose on account of indexation benefit, but there is something which is not going to be in your domain. Writing the examination will reduce only from the cost of acquisition. Don't think about this controversy at 2 to 5. Now, what will happen if the advance money is forfeited by the previous owner? Once the advance money is forfeited by the previous owner, there is no provision section 51 to reduce the cost. So, if the advance money is forfeited by the previous owner, the cost will remain the same, which is the cost of the previous owner. No need to reduce the advance money. So, just quickly run through all the sections. 55 2A deals with intangible asset, purchase price or nil. Financial assets, original shares, original cost, right shares, amount paid, owner shares nil, right pronunciation 0. So we take the case of the asset acquired by way of will inheritance and similar situations. We take the cost as cost of the previous owner. In the case of merger, take the cost of acquiring the shares of the previous company. In the case of a demerger, cost of acquisition of the demerged company into net worth, into the book value of asset transfer divided by total net worth. Whatever cost added here will be reduced from the cost of acquisition in the other company. So section 51 deals with forfeits of advance money. Whatever amount forfeited by me in my earlier negotiations will be reduced from my cost of acquisition. So if it is going to be received by the previous owner, there is no need to reduce the cost of acquisition. Now we'll move on into the cost of improvement. After purchasing the asset, there is always a possibility of you incurring certain expenditures on capital expenditure and additional alteration. If such capital expenses incurred after 1/4/1981, then such capital expense is allowed as a cost of improvement. So therefore, the cost of improvement is nothing but any capital expenditure on additions or alterations incurred by the SSC or the previous owner on or after 1/4/1981. This is very important to note. Expenditure incurred before 1/4/1981 will never be allowed as a cost of improvement. Now, so this will virtually complete your short-term capital gains. Now, when you take the case of long-term capital gains, the cost of acquisition, cost of improvement are going to be indexed. So, in the case of an indexation, if the asset is acquired before 1/4/1981, you have to index on the basis of cost of acquisition into the index of year of transfer divided by the base year index, which is 100. If you acquire the asset after 1/4/81, it's going to be cost of acquisition year of transfer divided by year of acquisition by the SSC. In the case of an improvement, it's cost of improvement into year of transfer divided by year of improvement. Don't worry about the index numbers. Normal index numbers are provided in the examination. So there's no need for you to memorize the index numbers. Now this will complete your computation of short-term and long-term capital gains. The next step is to adjust for the exemptions under 54 to 54 GA. That will have it in our next video.